Well, it's a very special morning for all of us here at CNBC TV18. It is a proud moment for all of us here at CNBC TV18 as we turn 19 today. We want to thank all our viewers for the support and loyalty all through these years, and we expect such support to continue for the coming 19 as well. Hi, Mangalam.
Hi, Anisha. Yes, definitely a very special morning. Just off the cuff, what were you doing when you were 19?
I don't even remember what I was doing when I was 19 or even 19 years ago. But would you have any memory?
I think I was watching CNBC TV18, was old enough to watch it, so yeah.
I don't think I used to watch business news that well when I was 19 years old.
But come to full circle that we're here right now and can't thank the viewers more. But it is a day when we start with the markets, and this is the top stories these are the top stories that we're tracking this Friday morning.
Well, okay, so Wall Street ends mostly lower but off-session lows on reports that Federal Reserve may turn more accommodative. The Dow ended with marginal cuts after plunging almost 800 points during the day. Asian markets off to a positive start.
Oil prices under pressure after OPEC agrees on a deal to cut oil production but did not specify the exact number of barrels by which it will pull back production.
IT bellwether HCL Tech goes shopping, acquires select IBM software products for $1.8 billion. With this largest ever acquisition by an Indian IT company, HCL Tech becomes the first company to make big foray into software products business.
CNBC TV18 Newsbreak confirmed the Union Cabinet approves the sale of government stake in Rural Electrification Corporation REC to PFC, Power Finance Corp. That is, the Cabinet also clears the agriculture export policy.
States of Rajasthan and Telangana go to polls today. Nearly 5 crore voters will decide the fate of around 2,200 candidates in Rajasthan. Around 3 crore electors will exercise their franchise in Telangana, where nearly 1,800 candidates are in the fray. More on that later on the show.
So let's take a look at the Asian markets before we start off for trade in the Indian markets. Yesterday was a turbulent Thursday for Wall Street. The Dow at one point was lower by almost 800 points owing to trade war concerns, economic slowdown fears, and then there came in a report that perhaps the Fed may take a pause ahead of their rate meeting on 18th and 19th of this month, and from there we saw a V-shaped vertical recovery in the Dow, which ended lower by just about 80 points. So in that regard, the Asian markets, they've started fairly in the green. The Nikkei higher by about 0.3%. The Korean markets too in the green as we speak. Interestingly, the SGX Nifty should come up for you. That one too is indicating a positive start for our market after the 180-point drubbing that we saw on the Nifty in yesterday's trading session. What will be important for us though, however, is the decision that took place, or rather the indecision that took place at the OPEC meet with regards to a production cut. They have delayed that decision to today, and let's see what kind of number do we get in terms of production cuts. The oil prices, they slipped to sub $60 per barrel and now hovering around that, so that's a positive for us. And second half of trade, perhaps the street will be playing in anticipation of the exit polls. It is Rajasthan and Telangana going to polls today. So in that regards, while we are always weighed by the global markets, we have domestic cues which reign supreme as well.
Okay, but let's talk a bit more about global cues because as you mentioned, it was a turbulent Thursday on Wall Street. Stocks closed well off their session lows after reports that the Federal Reserve could tighten monetary policy at a slower pace than previously expected. Now, the Dow ended just 80 points in the red, and this is after plunging almost 800 points. The S&P 500 closed just marginally in the red, while the Nasdaq actually managed to raise all losses and close in the green. We have CNBC's Eric Chemi getting us a wrap of all the action on Wall Street yesterday.
Volatile markets all over the place. Another big sell-off on Wall Street today if we had ended an hour or two earlier than we did. But all of a sudden by 4 p.m. Eastern time, the Dow fell only 79 points after being down nearly 800 points at the lows after dropping 800 points on Tuesday. And as you mentioned, the Nasdaq, it It was up today, but that was certainly not the case around lunchtime, let's say, for traders. Global markets had set the tone, with Britain and Germany falling more than 3% overnight after the big U.S. declines the previous day. The losses were largely spurred by the news last night that the CFO of Chinese telecom and handset giant Huawei was arrested in Vancouver, Canada, for extradition to the United States on charges of violating sanctions on doing business with Iran. Investors were spooked that the arrest took place on December 1st, the same day that Presidents Trump and Xi Jinping held their successful G20 dinner that sparked the trade truce earlier this week. And we're just getting late word that President Trump was not aware of the extradition request prior to his meeting with his Chinese counterpart. So that's why markets, they're trying to figure out what this all has to do. How does this arrest relate to the trade spat between China and the U.S.? And that's why I think the arrest caused such a big move downward. Reuters reporting today that banking giant HSBC is involved with Huawei's illegal transactions, while Dow Jones is reporting that it was actually HSBC that flagged suspicious Huawei transactions to U.S. authorities in the first place. So a lot is going on here today. Stocks did recover most of those losses after some positive U.S. economic reports and dovish remarks from centrist Fed officials, including Robert Kaplan, who appeared on CNBC, and upbeat remarks from JP Morgan CEO Jamie Dimon. He did an interview with CNBC's Becky Quick. Also a story in the Wall Street Journal suggesting that the Fed might take a wait-and-see approach to their rate hikes starting in December. So that helped investors think, hey, maybe there's not going to be as many hikes as we originally thought. And then finally, oil also stemming its earlier decline, although the OPEC meeting in Vienna came to no resolution by nightfall, and they're going to continue into the morning. All eyes on Russia now in terms of reaching some sort of production deal.
All right, and the yield curve doesn't spell recession at all, says Jamie Dimon, the chairman and CEO of JP Morgan Chase, in an exclusive interview with CNBC's Becky Quick. He remains upbeat about the U.S. economy and expects a rate hike by the Fed in December. So let's take a look at the excerpt of that conversation.
Still have a strong American economy. So if you speak to most of the CEOs, they say their order books are good, consumer balance sheets are good, the economy is growing, wages are going up, they're still hiring people, unemployment may very well hit 3.3% this year. That's all good. On the other side of it, you have a bunch of geopolitical stuff, oil, Brexit, but I think the one that's probably roiling the markets the most is trade. And the issue about trade is not just the direct effect, it's the indirect effect that how bad it's going to get, what can go wrong. And, of course, that fat tail of a trade war. If you weren't even thinking about that a year ago, and now people are thinking about how bad can it get. So that's why you see it's kind of swinging the market all over the place. And that, with the added thing, rates are going up, and is it recessionary? Now, I personally think the yield curve, it doesn't tell you that at all. But, that's the thought. There's something in the yield curve that's telling you might have a recession. So, but what we all see in the actual facts on the ground is you still have growth in America.
Well, that's a lot to
and growth in the world. We just met with the IMF, 3.7% this year. I mean, that's among one of the better growth for the world, not this year, next year, 2019.
I would say probably business leaders, but especially traders, pretty nervous. Is the Fed raising too far, too fast? This morning, the market was betting that there's only a 73% chance that they even go this month in December. And up to this point, that had been kind of 100% baked in. What do you think? Should they, based on what you see in the economy, because you have a pretty long lead?
I think when you talk about the risk of the Fed doing it too much, too fast, there's also a risk of doing too little, too slow. And, of course, it's easy for people who own assets to say it's all about lower rates, but the fact is a strong economy, normalizing rates is a good thing. So, my guess is the Fed's going to be looking at data right up to the last minute, and that they probably will do December. I don't think the Fed should be overreacting because the stock market went up or down, or people are afraid of trade, or stuff like that, or possible geopolitical events. And normalize is a good thing. The world will be much happier if America's growing and rates are going up a little bit than if we have a recession and rates go down. It's better for the world. So I think they'll probably stay on course, and of course people are going to adjust their speculation on that issue. So,
Jamie, I want to go back to something you said earlier. I don't know if it was this week or last week. You made some comments just about what you see in terms of a recession being out there. And the way it was reported was that you could see a recession potentially happening in 2020. I think you said maybe 2020, maybe 2021. Yeah. Do you actually see that, or is it just beyond, as far as you see, there's nothing?
I don't know. I mean, you guys always ask that question, and no one knows, and I think it's actually almost a waste of time to guess. Well, I was simply saying that there are a lot of things happening that may even come together the wrong way in late 2020 and 2021. It's possible, we've had, and this is another very important thing, 20% growth over 10 years. It should have been 40%. That anemic growth is part of the reason you have lower capital expenditures, that we didn't create enough high-paying jobs, that people didn't have enough opportunity. And it's like, we're not the tail end of the cycle, but it's possible this acceleration we're seeing is traditional for the last third of a cycle. So it's possible we've got 3 years left.
Right.
And, you know, with more jobs and more wages, and you still have capital expenditures are still up, by the way.
I was going to ask you about that, because there are different reports in different places.
But people are not looking at the facts. Yeah. They're still up year over year. They were up more in the first quarter, the second quarter, the third quarter. But a lot of these companies, and the real thing about tax reform wasn't what's the immediate effect.
Right.
We knew there's an immediate effect. Some people raised wages, some announced plans, some opened another factory or two. But the real effect is the cumulative retention of capital redeployed in productive uses in the United States for the rest of our lives.
Okay, but all eyes will be on the US Fed meet on December 18-19 now. Ahead of that, CNBC's Steve Leisman spoke to Dallas Fed President Robert Kaplan, who says growth will be slower in 2019. Here's a snippet of that exclusive conversation for you.
The short end of the curve is reacting to what the Fed has been saying. The longer end of the curve tells me that expectations of future growth are sluggish. I'm seeing input costs are rising. Tariffs is a part of it, but it's not the only part of it. And companies many of them are struggling to pass on those cost increases to their customers, and you're seeing margin erosion. And we're also seeing some deceleration of expectations for next year's earnings growth, which off a high base. And so when you put all that together, I just think there's a lot more uncertainty, and it's very consistent with what I hear from companies I talk to and what we see in our surveys. And I think the implications for me and my job as a central banker, I think getting to 2 to 2.25, I've had a lot of confidence that we should be moving along. I think at this stage, you're going to hear me be much more cautious and counsel patience. I think there's more uncertainty. Global growth's decelerating. I'm seeing some interest rate sensitive sectors showing some weakness. It's too soon to say what to make of it, but I think this one of the key tools we have as central bank is patience, and I think we ought to be using that tool.
Robert, I want to give you some credit because you were talking back in mid-October about getting to the range of neutral before the leadership at the board was talking about the range of neutral. Are we at neutral now, possibly, or how far below it? And do you still think we need to get there?
So neutral is by its nature imprecise and uncertain, and you're not going to see it on your screen. And so I think the range at the FOMC and our longer run rate is somewhere between 2.5 to 3.5. I'm at the lower end of that range. And so my guess is we're probably a little bit below neutral, but we're approaching it. We'll know in hindsight where neutral was, but I think normalizing monetary policy was always going to be challenging, and I think we're in the stage of this process where you're going to hear me shorten up on the prognostications and be much more vigilant as to what's going on in the economy, but particularly not just the data, but what the outlook is and what the markets are saying about the outlook and what companies are saying. And right now, I'm just seeing a high level of uncertainty, and I think it's a factor in my thinking.
All right, then that's as far as the Wall Street is concerned. Let's go across the Atlantic then, where the European markets cracked amidst fears of slowing down falling oil prices and a fresh flare-up in tensions between China as well as the US. China following the arrest of Huawei CFO in Canada. The European indices ending about 3.5% lower. This, remember, when the Dow was down about 800 points. So let's see how they open today. But the other big cue to track is the OPEC meeting, where the cartel has now agreed to decrease oil production but did not specify the exact number of barrels it aimed to bring off the market. Manisha, who was tracking all of this, joins in with the details. Manisha, good morning.
Morning. Well, absolutely. You know, it was one whirlwind of a meeting yesterday, and we kept waiting for the press conference, which never really happened because OPEC delayed its decision on production cut levels until today. So when you talk about the allies, really, it is going to be Russia, Oman, and Kazakhstan. And within this, Russia, of course, is the major ally that OPEC has been depending on. And Russia is yet to specify the production cut quota. And Saudi Arabia has been quite clearly saying that if all members are not willing to join and contribute contribute equally, they will wait until they do that. So clearly, this really seems like an open-ended statement and an open-ended meeting, which the markets will watch out for. While, of course, OPEC members have said that 1.3 million barrels per day of a cut would be good, but 1 million or less than that would be sufficient as well. So these are the kind of statements which have left a lot of uncertainty into the markets. At one point in time, we saw the crude oil prices decline by 5%. We did see a closing down 3%. And a bit of a support that you saw in crude prices really came in from the fact that the U.S. weekly inventories declined by 7.3 million barrels. This is after 10 weeks of build-up in inventories. So 1 week of very huge decline, and you saw some support come in for the crude oil prices because of that. So what is important today is that the OPEC and allies will meet at 2 p.m. India time, and there is an expectation that at 5:30 p.m. we will have a joint press conference from OPEC and the allies, that is Russia, and they will talk about a final number, a timeline there. And that really would soothe the nerves for the markets. At least we will have a number in front of us, and whatever reaction that is there to come will be seen. So as of now, there is no clarity. There is a lot of uncertainty, and the crude oil prices are looking at very, very exaggerated moves coming.